Welcome to The Explainer. Today, we're digging into a wild story from the world of startup investing, the Boxabl case study. We're going to see how this company went from just an idea that people backed online to a massive multi-billion-dollar company heading to the NASDAQ. All right, let's jump right in.
So let's start with a big question. Does that sound, a little too good to be true? $1,000 turning into 80,000? Well, this is the exact question at the heart of the Boxabl story. We're going to find out if this was actually possible for the people who got in early and, how on earth it happened.
And this is the number that changes the whole game. $3.5 billion. That's the valuation Boxabl hit in a recent deal. And remember, this is a company that just a few years back was raising its very first dollars from regular people just like you and me on the internet.
So in this explainer, we're going to break down exactly how early investors might have turned that $1,000 into over 80 grand. We'll look at the company, we'll do the math, but most importantly, we're going to unpack a framework that could help you spot the next potential winner.
Okay, first things first. Who is this company and what was the special mechanism that made this whole story even possible in the first place?
And there it is. The company is Boxabl. You might know them for those cool, foldable, tiny homes. And the mechanism? It's called equity crowdfunding. This is a total game changer, really. It's a set of rules that lets companies raise money directly from the general public.
All right, let's get into the nitty-gritty. In this section, we're going to unpack the specifics of Boxabl's journey and actually break down the math behind those absolutely insane returns.
So the huge news, reported by Reuters, is that Boxabl signed a deal to merge with something called a SPAC. Now, this deal puts them on a fast track to becoming a publicly traded company on the NASDAQ stock exchange, all at a massive $3.5 billion valuation.
And this timeline just shows how fast it all went down. I mean, look at this. It kicked off in 2020 with their first fundraise at a pretty modest $42 million valuation. And from there, they raised over $230 million from more than 50,000 regular investors, all leading up to that huge merger announcement in 2025. So you're probably asking, what the heck is a SPAC? Well, to put it simply, it's basically a shell company that's already on the stock market. Its only job is to raise a bunch of cash and go find a promising private company like Boxabl, merge with it, and boom, take it public. It's a different path to the stock market than a traditional IPO. Now, this is where it gets really interesting. Look at the math. If you were one of those early investors who put in $1,000 back in 2020 when the company was valued at just $42 million, well, that jump to $3.5 billion represents a paper lift of about 83 times your money. And that's exactly how a $1,000 investment could, in theory, explode into an on-paper value of around $83,000. And the thing that made all of this possible for everyday people is equity crowdfunding. New regulations, you might hear them called RegCF or Reg A+, basically kicked the door open. It meant that for the first time, you didn't have to be a millionaire to invest in private pre-IPO companies. You could do it right from your laptop. So this begs the question, right? Looking back, were there clues? Were there signs that Boxabl was going to be, well, Boxabl? The source material we're looking at suggests there's actually a framework for spotting these kinds of potential winners. The source lays out this 5-point checklist. It looks for rapid raisers, companies that raise millions in weeks, which shows huge demand. Then there's headroom, meaning it has a low starting valuation with tons of room to grow. You want to see a clear value trajectory where the valuation keeps climbing. It needs a moat, something that's really hard for competitors to copy. And finally, exit visibility, which are just signs that they're planning to go public. And that second point, headroom, this chart shows you exactly what we're talking about. When you get in at a low valuation like Boxabl's $42 million, and the company has the potential to exit at a massive valuation like $3.5 billion, well, that giant space between those two bars, for an early investor, that's where the magic happens. So if we look back at Boxabl through this lens, it checks all the boxes. It was a rapid riser, hitting its goals in no time. It had a clear value trajectory. The valuation basically doubled with each new round. Its factory system created a really powerful moat. And yeah, its public filings and all the market chatter were clear signs of exit visibility. The clues were there. So, how do we take all this and turn it into something useful, an actual playbook? Well, the source material we're using distills these lessons down into 4 pretty simple rules for aspiring investors. So here it is, the 4-rule playbook. Rule 1, build a watch list of companies that look promising. Rule 2, use what it calls the 10-ticket rule to spread your bets. Rule 3, run diagnostics on those companies using that 5-point checklist we just talked about. And Rule 4,
always, always keep dry powder. That's cash ready to go. Let's just zoom in on that second rule for a second. The 10-ticket rule. It's really all about diversification. I mean, startup investing is super risky, right? So the idea is that you're better off spreading your money across, say, 10 smaller bets, instead of putting all your cash and all your hopes on one single moonshot that might not pan out.
And that last rule, keeping dry powder, is key. The source suggests aiming to keep about 30% of your startup investment fund just sitting in cash. Why would you do that? Well, it gives you the firepower to double down on your winners in later funding rounds, or to jump on a brand new, amazing opportunity the second it pops up.
Okay, before we finish up, we have to talk about the other side of this. This is absolutely critical. We need to talk about the risks, because this is definitely not some guaranteed path to getting rich quick. Let me just be 100% clear here. For every single Boxabl, there are hundreds, maybe thousands of startups that fail. This is a high-risk, high-reward game, and you have to understand that it is nothing like investing in the normal stock market.
And this is a direct quote from the source material itself, and it's so important, I'm going to repeat it. You can lose all of your invested capital. Everything we've talked about today is for educational purposes. It is not investment advice. Now, for those of you who hear all this and think it's fascinating and you really want to understand how to analyze these deals better, the source material does point to more educational resources. It specifically mentions a video course called Unlocking Startup Wealth as one option for learning how to dig into pre-IPO deals in this crowdfunding world. And really, that brings us to the final thought. The Boxabl story is just a really powerful example of how the entire investment world is changing. It shows what's possible for sure, but more than that, it shows why you need a smart, disciplined strategy, because the next Boxabl, it's probably out there right now. The only question is, do you have a plan to find it?